Hello, everyone. It's Chris Kapches, CEO of Chestnut Real Estate. And today I'm going to be providing you with the December market report. But in addition to that, I'm going to look at all of 2025 and conclude the report by looking at 2026 and what we anticipate is going to happen as far as the Toronto and area resale market. It was a number of years ago that Queen Elizabeth made a year-end address and used the term annus horribilis to describe the year in which she was providing her report. And I think I could use Queen Elizabeth's language to speak to the December report and to what happened in 2025 as far as the resale market is concerned. I'm going to start with the December report, and you'll see some data on the screen. But essentially, in December, we have sales that are down. We have average sale prices that are down. We have inventory that is increasing, and not surprisingly, average days on market also increased in December. If we look at the actual numbers, you'll see that sales were down by almost 9% compared to sales last December. Only 3,697 sales came in. Our average sale price was down by a little over 5%. Last year it was $1,060,000. This year it's just slightly over $1 million. Our days on market had jumped to 41 days from 36 last December. And lastly, our inventory's up fairly dramatically for the month of December, with over 17,000 properties available to buyers out in the marketplace. All of those things are negative aspects to the market. And unfortunately, they've been a continuation of what we've been seeing regularly through the market reports that I've been providing you over the last few months. One of the areas that I should focus on before we look to what happened in 2025 as a whole is the condominium sector. None of the housing sectors were immune for these negative aspects that I've been speaking about, but in particular, the condominium resale market took another big hit in December. Sales were down by it varied from the 416 to the 905. And 905 sales were down by over 20%. In the 416, sales were down by about 6%. Combined, they were down by over 11%. That sector throughout 2025 has taken a hit and continued to take a hit in the month of December. A multitude of reasons for it. Also, the new construction side is involved in one of the reasons why the condo sector is not doing well. And perhaps when we get into 2026 reports, we can focus a little bit on that and explain why it's unfolding the way that it is. But for the purposes of this report, once again, condominium apartment sales were the worst performing, which is somewhat surprising because the condominium apartment sales have the lowest average sale prices. In the case of the 416, they came in at just over $660,000. In the case of the 905, just over $555,000. So you would think that they would be the most active part of the marketplace, but unfortunately they're not. So as I said, we end the year with the results for December, which I've just described and that you've seen. They're not particularly encouraging. If we look at what happened in 2025 as a whole, it is definitely an annus horribilis. The last time in a market report that I used that expression was back in 2022. And the reason I used it at that time is because we had come off the peak of the pandemic, and sales had begun to plummet as we made our way through 2022 towards the end of the year. The Bank of Canada began to increase its benchmark rate, and with that, mortgage borrowing costs skyrocketed in 2022, causing the year to finish for one of the lowest number of sales that we've seen in many, many years. In fact, in 2022, we came in at 79,000 plus sales, and I thought it was a really bad year, and hence used the expression annus horribilis. But ever since then, we've been declining on an annual basis. In 2023, we came in with just a little over 70,000 sales. Similarly, in 2024, but then in 2025, the year that we just completed, we came in at only 62,433 sales. That number is actually one of the lowest numbers we've seen in decades. In fact, we could go back to 1988 and we would get sales that are in and around that number. And I don't need to remind anyone that's listening to this report that back in 1988, the population of the Toronto region was about half the size as it currently is. Yet notwithstanding that, sales are down to the same level as they were back then. If we look at the early 90s when we were going through a recession and then coming out of it at the tail end of the 90s, similarly, sales were in that area, but in fact even higher than the 62,433 sales that we accomplished in 2025. So we're talking about a huge recession as far as the sales numbers for the year, and a huge recession in the last 3 or 4 years in terms of the sales that we have seen. Again, I probably don't need to remind anyone, but during the period, that decade leading up to the beginning of the pandemic, we were averaging over 90,000 sales a year. And at the peak of the pandemic, we did over 120,000 sales. So we clearly are finding ourselves in a very, very slow, regressive real estate market. What are the causes for that? Well, they can probably be summed up as 2 causes. One, uncertainty. And the uncertainty flows at the, for lack of a better expression, at the macroeconomic level. We have, of course, the introduction of the tariffs that came into effect in 2025. Chaotic process. There were times when they were in effect, other times where they were being retracted, but it created incredible uncertainty. Also, politically, on an international basis, the uncertainty has been anything but positive for the real estate market. And then in addition to uncertainty, we have the affordability issue. Interest rates, borrowing costs continue to remain high. During 2025, the Bank of Canada reduced its overnight lending rate 3 times. At the end of the year, we're down to 2.25%. In fact, they had an opportunity in December to reduce it by a further amount. They didn't do that, so it ends the year at 2.25%. But unfortunately, the borrowing costs, at least as far as mortgage interest rates are concerned, are driven by the bond market. And the bond market is also driven by all the macroeconomic uncertainty that I just spoke to a moment ago. So as a result, the bond prices have remained high, and in turn, so have borrowing costs. As we speak today, if you're looking for a 5-year fixed-term mortgage, you're probably going to be paying somewhere in the neighborhood of 4.4 to 4.5%. Still relatively high. Not as high as during the recessionary period that I spoke about before in the 1990s, but back then average sale prices were a little over $200,000, and as you know, the average sale price today is over $1 million. So affordability has become a real problem for most buyers. So you combine affordability issues with uncertainty, both at the macroeconomic level and then even domestically. Those two factors combined make for a slow real estate market. So what do we look towards as far as 2026 is concerned? Well, unfortunately, many of the factors that were in play in 2025 are going to be in play in 2026. The macroeconomic uncertainty, job uncertainty, affordability uncertainty, those are all going to be in play in 2026. In addition to that, affordability is not likely to improve dramatically, at least not on the borrowing side. Bank of Canada, during its last meeting, indicated that it's probably going to keep rates steady through 2026, which means that we're not going to see any relief from the Bank of Canada. And certainly, if the turbulence that's going on in the world continues into 2026, then that means that bond prices are going to stay high as well. So there's not going to be much relief for buyers looking for improved mortgage interest rates. That being the case, all forecasts, and there seems to be some unanimity in terms of what we believe is going to happen in 2026, we're probably going to see improved sales, but not to the levels that we had pre the pandemic. We're probably going to see a 5, perhaps an 8% increase in the number of sales. But even at that, we're only going to be at the end of the year somewhere between 65 to 67,000 properties sold. Again, that takes us back to a number reminiscent of the mid-1990s. So even with an improvement in the number of sales, we're still going to be in a position where we're not seeing the kinds of numbers that we got used to leading up to the pandemic and then the early years of the pandemic. So somewhere between 65 to 67,000 sales. But conversely, those sales are going to take place to some extent as a result of declining prices, because the affordability issue and the uncertainty and of course the inventory levels that I spoke about earlier are going to be giving buyers some time. They're going to be giving buyers some choice, and ultimately they're going to be giving buyers leverage. And that leverage is going to be resulting in a retraction in average sale prices, somewhere between 3 to 5%, so that by the end of 2026, the average sale price should be around $1 million, perhaps a little bit less. Again, reminiscent of what the average sale price was just before the pandemic started in 2020. So that's what's happened in 2025. That's the outlook for 2026. I look forward to the monthly reports that we'll be doing in 2026, keeping you up to speed on how the market is unfolding. And I would like to hope that by the end of 2026, we certainly won't be using Queen Elizabeth's language, but perhaps more positive language as a result of the market unfolding in a more positive way. But until then, stay well. Thank you.